America's economic landscape is rapidly changing. In recent years, hundreds of thousands of stores were permanently shut down. And as we enter a new economic downturn, many more are likely to close their doors for good. Conditions for business owners are getting increasingly difficult as the compounding effects of inflation, supply chain challenges, and slower consumer spending continues to compromise their sales and profits month after month. New data suggests that pessimism in the retail sector is growing all across the board, and even big companies are struggling to stay afloat right now. Many of the most iconic American retailers have closed thousands of stores and filed for bankruptcy as they have failed to keep up with their competitors. The rise of online retailers made many brick-and-mortar stores seem redundant. Even though companies tend to think that they have something unique to offer their customers, the reality is that not enough of them actually do. Some, in fact, lose touch with what shoppers truly want and need for such a long time that when they realize there's no turning back or quick fix, they have no choice but to go out of business. In this video, we've listed a series of stores that are suffering from a lack of customers, a lack of money, a lack of viable prospects, or a combination of all of those issues. Many of them have already shuttered dozens or even hundreds of locations all across the nation, or are in the process of closing down in 2022. Soon, they may disappear from our commercial scene altogether, and we might never get the chance to shop at these stores ever again. Before checking this list, please support us with a thumbs up and subscribe to our channel so you don't miss our next lists. Without further ado, here are 15 big stores that will probably disappear soon. 1. Sears. Sears' annual revenues have been steadily falling for almost 15 years. There used to be thousands of Sears stores in the US in the early 2000s, but now there are only 25 stores left. However, in May, the company announced that it's going to close 7 more locations this year. Sears filed for bankruptcy in October 2018 and still hasn't been able to become more profitable and turn things around. In fact, data shows that the company hasn't turned a full year profit since 2011, and same-store sales have fallen for 10 consecutive years. After filing for bankruptcy, Susquehanna analyst Bill Dreher noted that the move was only delaying the brand's inevitable end. Sears' operational performance is clearly not improving, and we grow increasingly concerned whether the company will ever return to profitability. Further highlighting the company's weakened position is the reality that manufacturers are increasingly demanding tighter payment and/or withholding products, he wrote. At the current pace of closures, we might not have any Sears stores left in the country by mid-2023. 2. Barnes & Noble. The famous bookstore chain crashed after the pandemic, filing for bankruptcy in March 2021. Although it has been recently purchased by the British group Elliott Advisors Limited, the rise of e-books and online booksellers continues to threaten the future of the book retailer. Over the past 2 years, the company saw a 50% decline in revenue, according to the New York Times. Late last year, it announced the closure of 197 out of its remaining 600 stores. Scott Amex revealed that Barnes & Noble is suffering a $10 million yearly loss in overall sales. He said the book chain is hemorrhaging cash flow. As consumer trends continue to accelerate towards technology, losses will likely get bigger and bigger for Barnes & Noble, and at some point, conditions will become unsustainable for this beloved bookstore chain. 3. Rue 21. Since 2017, the privately owned teen retailer has been overburdened with debt. Executives acknowledged that the company didn't keep up with the evolution of consumer tastes and filed for Chapter 11 to renegotiate its debt. From that point on, the retailer lost about 420 stores, or more than a third of its brick-and-mortar footprint. Unfortunately, fewer stores mean a smaller scale in a low-margin industry that requires scale. In other words, they're hanging by a thread. 4. Belk. The southeastern department store Belk went through the entire bankruptcy process in 2021, shedding about $450 million in debt. Although it has been saved by a group of investors for the time being, the future of the store chain is far from secure. Moody's Analytics data shows that the company has a very poor credit rating and a negative earnings outlook for 2022. That is to say, Belk is still at risk of facing more financial difficulties, and considering that it's still reliant on its brick-and-mortar operations and lacks an e-commerce foothold, it could be in for a rough 2023 as it fails to keep up with its bigger competitors. 5. JCPenney. Another legacy brand that might end up on the chopping block. JCPenney. Things were pretty bad for the company even before the burst of the health crisis, but lockdowns and stay-at-home mandates had a devastating effect on the retail sector, and some argue that the pandemic was the last nail in the coffin for the company. JCPenney had already had its share of tumultuousness, highlighted C Street principal at C Street Creative. With about 600 physical stores left standing, and a primary, older demographic who does not tend to use e-commerce as much, there could be trouble for their ability to survive 2022 and beyond. In October 2021, it announced the closure of 242 stores, and many more can occur as it goes through a bumpy merger this year. 6. Gap. According to the financial blogger Stacey Caprio, one popular brand that could disappear in 2022 is Gap. They weren't turning a profit last year in their public balance sheets, and their revenue is based heavily on retail store visits and retail store sales, both of which have taken a sharp downturn due to COVID lockdown policies this past few years. To stay in business for a long time, they will have to innovate and focus more on online than retail, so they can weather unexpected storms such as the one that happened in 2021, she wrote. In April, Gap was facing a $2.25 billion debt load, which led the company to warn that it could run out of money in the next 12 months. The casual clothing retailer also announced the suspension of rent payments for all its remaining stores, adding another $115 million to its debt burden. Needless to say, that's a perfect recipe for disaster. We soon may see the last of Gap. 7. Abercrombie Fitch. The teen targeting clothier has been struggling for years as expensive labels fell out of fashion, and more recently fending off the impact of some controversial comments made by now former CEO Michael Jeffries. It first filed for bankruptcy in 2008, and in recent years it has seen its profit margin dramatically shrink. As far as retail footprint goes, the company has been continuously retreating. In 2020, Abercrombie Fitch shuttered 137 store locations. During its last earnings call, it indicated that it would close as many as 60 U.S. stores in the next few months. Deutsche Bank analyst Tiffany Kananga is bearish about the future of the company. We're highly skeptical of Abercrombie's ability to stabilize its gross profit margin against this competitive online retail backdrop, she wrote. 8. GNC. In 2020, vitamin and dietary supplement chain GNC filed for Chapter 11 and announced the shutdown of 1,400 stores. In statements posted on its website, GNC said the business had been under financial pressure for the past several years, but the repercussions of the health crisis created a situation where we were unable to accomplish our refinancing, and the abrupt change in the operating environment had a dramatic negative impact on our business. Industry insiders argue that as the internet opened the door to a flood of competitors that offered more and cheaper choices, GNC stores have become increasingly obsolete. Other locations ultimately could be added to the store closing list, given that the company is still scrambling to implement its new restructuring plan. 9. Charlotte Russe. Another retailer that could disappear, or at least significantly fade away in 22, is Charlotte Russe, said Paul Z. Shelton Jr., MSF founder and chief investment officer of Warwick Shore Advisors. Founded in 1975, the retailer has stamped its presence on clothing, shoes, and accessories, targeting women in their teens and 20s. The company currently operates stores in 45 states, with the majority inside large shopping malls. Consumer traffic in these locations is significantly lower, painting a negative picture for the retailer. Unfortunately, I don't believe that consumer preference will shift in favor of Charlotte Russe, the expert added. Even before the U.S. economy started to head towards a recession, the company filed for bankruptcy and announced it would close 100 stores and sell its intellectual property. Given the current economic outlook, things may soon take a turn for the worse for Charlotte Russe. 10. Staples and Office Depot. The problem that office supply stores will face is that one does not need to see an item in person to buy it, says Jesse Harrison, CEO of Employee Justice Legal Team. If you need a stapler, you know what you need, and you can buy it online. Everyone knows what paper looks like. You don't need to go to the store to check it out. You don't need to try it on. Office supply stores like Staples and Office Depot are likely to close in the next few years, he predicts. Since December 2019, Office Depot stocks have been in consistent decline. Over the past 2 years, 190 Staples and Office Depot stores were shuttered in the U.S. In 2015, there were 2,600 stores in operation, but now there's only about 1,100 locations still running across the country, a trend that truly highlights the rapid demise of the retailer. 11. True Religion Apparel. Just like defunct The Limited, as well as Aeropostale, Bon Ton, and Pacific Sunwear, youth-oriented retailer True Religion Apparel belongs to a list of retailers that may be beyond salvaging. It first filed for Chapter 11 in 2017, having pared its total debt to roughly 1/4 of its pre-bankruptcy levels. In 2020, the company filed for bankruptcy for a second time, with the pandemic resulting in the permanent closure of over 140 stores all across the nation. Now, there are only 44 True Religion stores left, but their time may be counted. With the rise of independent fashion brands on the internet, the era of spending hundreds of dollars on a pair of off-the-rack jeans seems to be over. 12. AMC. AMC is still the largest theater chain in America, but as streaming services become more and more popular, keeping its 620 locations spread across the country will be increasingly difficult. Even though the company saw its share price skyrocket as it became a meme stock in a historic gamma squeeze led by retail investors, its financial conditions have not improved enough to justify the size of its brick-and-mortar presence. Last year, the cinema chain warned it could run out of cash and that it would have to file for bankruptcy if it did not obtain liquidity. Right after that, AMC went on to raise $104 million after selling some $38 million of $200 million in shares. But it still remains strapped for cash, and in December, it announced that it planned to raise an additional $125 million by selling 50 million shares. In total, AMC managed to raise $204 million, but as of early January, CEO Adam Aron said that the company needed $750 million to actually be able to survive. That's a huge sum, even for companies with great performances, which, by the way, is not the case with AMC. 13. Alex and Ani. Jewelry chain Alexander's filed for Chapter 11 late last year. Just like most retailers, the company has been hurt by the pandemic and has seen declining foot traffic in all of its physical stores. That has fueled the shutdown of a third of its locations. But that was not the worst part of the story. Bank of America has recently sued the company, claiming that Alexander defaulted on a $50 million credit facility. The legal squabble resulted in millions of dollars more in legal fees for the stressed retailer, and it might have put it one step closer to the edge. 14. Party City. Launched in 1990, Party City was the ultimate last-minute go-to for special occasion staples, be they paper plates or jumbo balloons. But now it seems like the party is close to an end. In the new normal, we cannot celebrate as we usually do, explained Antonio Wells, Naming Art, a brand growth and strategy marketing agency based in Chicago. Birthdays, festive holidays, graduations, weddings, and even Party City's biggest day of the year, Halloween, have all been cancelled. Since the pandemic has killed most normal public gatherings, it has dampened those few celebrations that do happen. This reduced sales volume is not enough to sustain a retail franchise whose revenue derives from seasonal sales. But the company has been on its last legs way before the health crisis changed life as we know it. In 2019, the retailer closed 45 stores due to shortages of key products. It goes without saying that the myriad of supply chain disruptions we're witnessing right now means more trouble for the Party City. 15. Kmart. The discount store chain, which peaked at 2,400 stores in the early 1990s, has failed to modernize its stores, and larger competitors such as Walmart and Target took away much of its market share. Today, there are only 3 open Kmart stores in the U.S., as the company has faced a brutal process of almost complete liquidation. Both Sears and Kmart were owned by Sears Holdings, which first filed for Chapter 11 bankruptcy protection in 2018, narrowly escaping liquidation in early 2019, just to be caught off guard by nationwide lockdowns in 2020 and to see sales going free fall. Both chains were sold to their longtime investor and CEO, Eddie Lampert, who has kept them alive on a shoestring budget under the company name Transformco. Together, Sears and Kmart have shut down more than 3,500 stores and cut about 250,000 jobs in the past 15 years. The disappearance of so many big stores is a major signal of economic weakness. The phenomenon known as the retail apocalypse is nothing more than a reflection of a shrinking middle class that's been too overburdened with debt and soaring living expenses. Middle-income earners have also lost so much purchasing power that they're left with too much little money to spend on other goods after paying their bills at the end of each month. More and more, middle-class Americans are turning to discount stores because they can't afford to shop at brand-name stores anymore. The shift in consumer habits towards online shopping has also been the impending doom for brick-and-mortar stores. Not only that, e-commerce is much more competitive in terms of price and promotions, and you can purchase whatever you want with only a click. Hundreds of thousands of businesses have been closed in the past 5 years, and according to UBS data, 80,000 more might be gone by 2026. The shutdown of each of these locations means that dozens, hundreds, or even thousands of jobs are going to be lost at a time too. America's economic landscape is looking gloomier and emptier, and the death of big business shows us that something is terminally broken in our system. Thank you for watching. We look forward to your comments underneath this video.